ATAD 3 is a European Council directive published on the 22nd of December 2021, targeting the misuse of shell entities for tax purposes. It forms part of a series of measures by the EU to tackle tax avoidance. And this particular measure seeks to introduce a new EU substance test for holding entities. In summary, ATAD 3 aims to achieve this objective as follows. First, it seeks to identify the in-scope entities. To do this, there are three gateways that an entity has to pass through to be within scope. First, 75% plus of its revenue or the value of its assets must derive from passive sources or passive assets, such as shareholdings, real estate, or IP, or other similar passive assets. Secondly, 60% of its revenue or asset value must come from cross-border sources. So it's important that this is a measure tackling cross-border transactions. And thirdly, the entity must have its administration and day-to-day operations outsourced, i.e. provided by some third party and not internally, for example, professional management companies. If those gateways are met, then there is a requirement on any such entity to report and report in relation to its substance requirements or substance indicators. An in-scope entity must report as to whether they meet certain minimum substance standards. Those standards are essentially that there are premises available for exclusive use of the entity. The entity must have at least one active bank account in the EU, and the entity must have at least one qualified director geographically close to the entity and dedicated to its activities. If these substance indicators are not met, then the entity will be assumed by the directive to be a shell entity, unless that entity can rebut that presumption through evidencing the commercial rationale for the existence of the entity and the structuring of the entity, or it can be proven that the existence of the entity does not reduce a tax liability for its owners or another company in the group. But if those, if the entity cannot prove or rebut the assumption that it's a shell entity, then certain tax consequences will follow on from that. Principally, there will be a denial of tax treaty or tax directive benefits that the entity might otherwise have had access to, so particularly reduced withholding tax rates or the application of participation exemptions. There will be a prohibition on local tax authorities issuing residency certificates to such entity, again, critical for obtaining tax reliefs. And finally, the entity is likely to have a form of look-through treatment. Effectively, it will be ignored for tax purposes, and any assets or shareholdings that it has will be treated as held directly by the shareholders, which again could cause tax benefits to fall away or additional tax compliance consequences for the shareholders. So that's essentially how ATAD 3 works to impose substance requirements. It is backed up, or will be backed up, or is intended to be backed up by very significant penalties to ensure compliance, and it's discussed that at least 5% of turnover could be levied as a penalty if compliance is not adhered to. Another factor to bear in mind is that the ATAD 3 sort of information that is gathered, particularly in relation to the reporting required for in-scope entities, will be available to be widely shared around Europe on request, provided to other tax authorities to police and administer compliance more generally with tax affairs in and around Europe. The target date for implementation is 30th of June 2023 for the rules to be transposed into the domestic law of member states. And then the plan is for those rules to go live, i.e. for the effects of ATAD 3 to be introduced domestically from the 1st of January 2024.
Yeah, this is a good question. I believe implementing ATAD 3 into German law becomes a challenge. Different to other reporting schemes like CRS, DAC 6, or CBCR and similar, ATAD 3 will come with material tax consequences. Thus, It is not just a new stand-alone regulation, and the interactions with already existing regulations must be carefully examined. But Germany has already a lot of anti-abuse rules with respect to outbound and inbound investments. With respect to inbound investments, there are various regulations denying expenses in case of qualification mismatches, interest bureau rules, license bureau rules, and similar. For outbound investments, they are usually subject to the recently changed controlled foreign company rules and various treaty overrides to avoid double tax treaty benefits for German residents where they are not justified in reality. But let us focus a little bit on the investment and the already existing framework. So starting with the Federal High Court in 2000, which ruled that in respect to shell companies outsourcing management functions and administration functions, that is not a general anti-abuse. But which rather, usually if the shell companies doesn't have any people and no outsourcing, it is denied for tax purposes, which seems similar a little bit with the ATAD 3 look-through approach. On the other hand side, we have the German CFC rules, which provide a little bit on the escape clause with respect to companies providing a proof of a sufficient level of substance. And third, from a perspective for the reporting, German shareholders usually, if some criteria are met, needs to report their shareholdings in offshore companies. However, all the reporting requirements regarding outbound investments usually refer to the German resident investor abroad. So these are only some examples, but it should highlight that there's already a bucket of regulation to capture shell companies, which sounds a little bit comparable to what ATAD 3 outlines. Different to the current reporting obligations, ATAD 3 seems broader, since the EU shell company itself is obliged to report and the shareholder only carries the consequences. However, the consequences on the other hand side, for example, the look-through approach targets the same goal than the German CFC rules. The taxation of the income accrued in the offshore shell company should be taxed at the hand of the shareholder. Therefore, it seems realistic that there's a high probability of overlaps, and any double taxation by applying different systems with the same goal should be avoided. Yeah, the impact on FinCos, so treasury centers of multinational enterprises, could be quite high. And I'm a little bit skeptical that the ATAD 3 regulation really takes a sufficient account of the reality. But let me explain that on an example. So you have a German headquarter multinational enterprise that has, for reasons of liquidity management, different hubs to approach the capital market. For example, and let's assume that the multinational enterprise has 3 treasury centers in a new country, which offers a possibility to nominate the balance sheet of the entities in different currencies. So these 3 currencies are nominated in euro, sterling, and Polish zloty, which is in line with the currency needs of the multinational enterprise. Each of the treasury center issues bonds to the capital market and receive the respective currency. These proceeds will be forwarded then to the subsidiaries in the countries where the liquidity is needed, in euro, in sterling, and, for example, in Polish zloty. This structure enables the multinational to hedge the different currencies naturally in the balance sheets, which avoid additional hedgings and therefore saves a lot of costs. At the other hand, to avoid additional operating costs, the sterling and Polish zloty treasury centers outsource the managing day-to-day business to the euro-nominated treasury center, which has 20 employees to render all the duties. But if you now take a look on ATAD 3 for that one, especially to the sterling and Polish zloty-nominated treasury centers, so they receive interest from the subsidiaries of the MNE, which would qualify as passive income. And naturally, to the business case, they receive more than 75% of their income from even this passive income. So most of the business of them is cross-border because they just forward via a loan the liquidity to the respective subsidiaries in another country. So, and third, the outsourced of the management and administration is quite clear, as I mentioned. Therefore, the two treasury centers could be treated as at risk and needs to meet the substance requirements, so having premises, a bank account, and one qualified director, at least. If this test is not met, the entities needs to provide additional documents and evidence to avoid the presumption of being a shell company. This will increase again the cost of compliance and bears the risk which comes along with any case-by-case analysis. So this example shows that typical structure caused by solely business reasons increase the compliance effort of the companies, especially where a multinational enterprise rely on their own tax compliance management approach. However, I believe that all business-related structures should not result in additional tax burden, because otherwise the ATAD 3 goal, challenging tax structures, will not be met, which raises again additional questions regarding the justification of the regulation. So as so far, from German perspective, looking forward how ATAD 3 becomes implemented into German law and what the overlaps are.
So as far as France is concerned, I'll say that France already has a pretty strict and developed regulation in terms of substance requirements. So even though it's unofficial, meaning that there is no definition within the law, it is still quite efficient, and you can see it just by looking at last year. There's at least 3 main case law which has been ruled and tackled, transactions involving shell entities. One of them, which is quite famous, has been ruled by the Supreme Administrative Court. It's known as PRS, and it's named after a UK company which was collecting actually royalties from a French taxpayer. And those royalties were distributed, 100% of the income which was collected was redistributed to authors and artists based in the UK for some of them, and some of them were based elsewhere in the EU. And of course here, the court decided to deny the benefit of the French and UK double tax treaty to that entity because of the lack of substance of the UK entity. But what is quite interesting to see in that case law is that the court agreed to apply the double tax treaty with the beneficial owners, which were, again, some of them based in the UK. So it applied the French and UK double tax treaty with those beneficial owners when it was possible to do so, even though the court had no legal obligation to do so. So now going back to ATAD 3 and what it will bring to the table compared to the current regime applicable in France, it's quite difficult to say for now, but I'll say maybe there is 4 different points, 2 upside and 2 downside. The first upside is probably it will bring some objectivity, some clarity, because there will be a definition, written definition in the law regarding, the substance requirement and lack of substance as well. Also, one of the upside is probably there will be this time a legal obligation for the French tax authorities, but also the courts, of course, to look to the beneficial owner. And when this beneficial owner is based somewhere in the EU, for instance, there will be a possibility to apply the mechanism, the provision provided by the EU or the double tax treaty concluded with France. So these, I think, will bring more a safer environment for the French taxpayer. On the downside now, probably one of the main concerns is to make sure that we will have the same definition that France, the French tax authorities, will retain the same definition, the same analysis as the one returned by the state, where the entity will be located, which is not completely an easy task, let's say. And last but not least, I think the last downside will be, of course, the administrative burden and the cost going with it, with the reporting obligation, which is applicable as from the beginning of 2022.
It is expected that ATAD 3 will change the current tax landscape through the introduction of an EU-wide substance test. The scope of ATAD 3, as it stands now, it is very broad and covers all the companies established in the EU market zone. Exception to these rules are entities that are subject to transparency requirements and supervision, such as EU collective investment vehicles, companies whose main activity is the holding of shares in operational businesses in a domestic context, and companies with at least 5 full-time equivalent employees. Luxembourg, being the largest fund centered in Europe and second largest in the world, welcomes these exclusions. Especially the exclusion of EU collective investment vehicles is very important for the European fund industry, which has predominantly cross-border operations and regularly entrusts the management of those operations to external investment fund managers. The exclusion of EU collective investment vehicles from the scope of ATAD 3 is justified, taking into consideration the existing economic reality and the predominant investment operating model in the EU. There is still a lot of way to go for ATAD 3 to be adopted and implemented. Nevertheless, we can only welcome initiatives that aim at increasing transparency in tax matters. ATAD 3 will be a step to the right direction. However, there is no doubt that ATAD 3 is coming with a lot of uncertainties, a lot of gray zones, and sometimes increased costs for the taxpayers. Let's take, for example, the case of a company falling within the categories that would like to obtain an exemption due to lack of tax motives. To do so, the company should prove that its incorporation will not reduce the tax liability of the overall group or of the ultimate beneficial owners. This will require a complex and costly multi-jurisdictional tax analysis, and is going to have an uncertain outcome. It remains to be seen what will be the final text of ATAD 3 and how this new initiative will actually be implemented in Luxembourg and in the rest of the member states.